I made one simple investing tweak and it set me on a path to retire comfortably by age 45. Making this tweak could let you retire a full decade earlier, all without having to stress about market volatility. So in this video, I'm going to show you exactly why aiming for a big portfolio number is holding you back and give you a safe, easy, step-by-step guide to implement this powerful income generating strategy starting today. So first, let me show you why aiming for a big number in your portfolio is not the best approach. You see, most people have been taught that retirement is all about hitting some magic number in your portfolio. You've probably heard the classic advice financial planners love to throw around.
Or just get to $1 million.
Or with the latest figures, actually, it's you need 1.46 million to retire comfortably. But here's the big issue with that approach. It's focused on the wrong metric entirely. Because what truly matters for retirement isn't the total amount of money you have sitting in an account. Instead, it's how much reliable cash flow your portfolio consistently produces. Because think about it this way. If you have $1 million invested, but you're only making a 2.5% dividend each year, that's $25,000 annually. And could you retire on that? Probably not. But instead, what if there was a simple, safe way to consistently earn significantly more income, even from a much smaller portfolio? That would completely change your retirement timeline. And here's where most investors hit a wall. Because if your portfolio's income doesn't fully cover your living expenses, you're forced to start withdrawing from your principal. After decades of diligently putting money into your account and seeing that number grow, you suddenly have to reverse course and start taking it out, and really hoping and praying it lasts as long as you do. And what this does is it creates enormous psychological stress, because every market downturn feels terrifying because you're now forced to sell assets at depressed prices just to cover your expenses. And so you're constantly worried about running out of money before you run out of time. But there's a smarter, safer way, and one that flips this entire approach on its head. Instead of anxiously hoping for market appreciation, you can now proactively generate consistent cash flow regardless of the market condition. And let me show you exactly what I mean with a real example from my own portfolio. Now, recently, I took a position in a high quality ETF that I'd be happy to own long term. But instead of just buying and holding the stock, I used a simple strategy to immediately get paid up front. And you see, in this one trade alone, I received $1,515 instantly from a position that would otherwise just be sitting there doing nothing. And the beauty of this approach is it works in virtually any market condition. Really everything except perhaps a rapid flash crash, because in bull markets, you just make steady profits. In sideways markets, you're consistently collecting cash flow while others are just frustrated by stagnant prices. And even in moderately bearish markets, you're significantly outperforming traditional investors who are just nervously watching their account balances shrink. And I've personally used this strategy consistently for the past 6 years, generating over $300,000 in reliable cash flow. Money that I've earned regardless of whether the market was soaring, stagnant, or even sinking. But this example clearly illustrates just how transformative the right approach can be when you shift your focus from portfolio size to reliable cash flow generation. What's truly game-changing about this strategy is its ability to consistently produce 15 to 20% annual income from your portfolio. And just think about what that means from a practical perspective, because now instead of needing 1 or 2 million saved up, you could potentially retire comfortably on just $500,000. And that's the difference between retiring at 45 instead of waiting until you're 65. So what exactly is this powerful strategy that's accelerated my retirement timeline and could accelerate yours as well? It's to do with selling options. Now, let me show you exactly how that works. You see, the strategy I've been using for the past 6 years is all about generating immediate consistent income from stocks without having to wait for price appreciation or dividend payouts. Because think about the traditional approach for a moment. You buy a stock and then you just wait. You wait for it to rise, you wait for the dividend payouts, and really you're just at the complete mercy of the market. But what if you could create your own dividends, paid immediately, regardless of what the stock does in the near-term future? And that's exactly what this strategy allows you to do. Instead of just waiting 3 months for a 0.5% dividend payout, you can now consistently generate 1 to 3% every 30 to 45 days. And yes, this strategy does involve options, but not in the risky way most people think of. I'm not talking about buying calls or puts and hoping for a big move, because that is simply gambling, not investing. Instead, I'm talking about selling options, specifically selling put options on high quality companies. Now, here's how that works. When you sell a put option, you're simply agreeing to buy shares of a stock at a specific price. That's called the strike price. If the stock drops below that level by a certain date, which is what we call the expiry date. Now, in exchange for making this agreement, you get paid cash up front. This payment is called the premium, and it's yours to keep no matter what happens next. So let's run through an example quickly. Let's say you like Amazon, which is currently trading at about $170 a share. Rather than buying the stock outright at the current price, you could sell a put option with a strike price of $185, expiring in 33 days. For making this simple agreement, you immediately receive $4.85 per share into your account. That's $485 in total, since each option contract represents 100 shares. In 33 days' time, when the option expires, one of two outcomes will happen. Scenario 1, the share price stays above $185. In that case, you keep the $485 that you got paid for selling the option, because the option has expired worthless. And now you can immediately repeat the process again to earn more premium. In scenario 2, the stock falls below $185 per share. In this scenario, you're required to buy 100 shares at $185 each. But remember, you already received $4.85 per share. So your real cost for each share is just $180.15, which is about 5% lower than the original market price. This is why I call it getting paid to buy stocks at a discount. You're essentially placing a limit order below the current market price, but instead of just waiting and hoping for the stock to maybe hit that level, you're getting paid up front to do so. And one of my students has applied this method so consistently that his average cost per share on Nvidia is actually negative $30. So that means he's been paid $1.30 in premiums for every $1 he spent buying the shares. So even if Nvidia goes bankrupt tomorrow, he'd still walk away profitable because he's already earned more cash from the stock than he's spent buying it. And now results like that don't happen overnight. They're the product of patience and consistently applying this powerful strategy over time. But before we dive into exactly which stocks are ideal for this strategy, let me quickly warn you about what not to do, because this is absolutely critical, and it's the number one mistake I see beginners make with this strategy, and it can completely derail your success. You see, the biggest and most dangerous mistake people make is chasing stocks that offer massive premiums. You see those massive upfront payments and you can't resist the temptation. But let me be crystal clear about this. It's a recipe for disaster. Because remember, your goal here is steady, reliable income, not just gambling on risky stocks. And if you pick the wrong stocks, you could quickly rack up losses that wipe out months or even years of income gains. And I've personally seen people blow up their entire accounts this way. They rush in to collect a few $100s in premium only to get stuck holding stocks that lose thousands of dollars in value practically overnight. Because this strategy isn't about chasing the highest immediate returns. It's about consistently generating safe, reliable cash flow that supports your lifestyle for years and decades to come. Think about it this way. Would you rather collect a modest income from a stable, high quality company that's likely to hold its value, or chase big premiums on a volatile stock that could plunge 50% overnight? Now, the answer should be obvious. The stable company with a modest premium is the smarter choice every single time, because consistency beats gambling every day of the week. So which stocks should you choose to safely maximize your income and minimize your risk? The ideal stocks for this strategy share three distinct characteristics. First, they've got to be companies you'd be genuinely happy to own long term. This is absolutely critical. You got to look for businesses with strong fundamentals, consistent revenue growth, and clear competitive advantages. Second, they should have moderate amounts of volatility. Not too low, or your premiums will be non-existent, and not too high, because then you'll be taking on unnecessary risk. Third, they need to have good levels of liquidity, plenty of trading volume. You want to be able to easily enter and exit positions without hassle. Great examples of stocks that fit these criteria would be companies like established tech companies with strong cash flows, consumer staples with predictable earnings, and then financial institutions with solid balance sheets. Now, notice what's not on this list. No speculative growth stocks with no earnings, no meme stocks, no pre-revenue biotech firms, basically anything that could plunge overnight. Because remember, selling a put means you're agreeing to buy the shares if that price falls below your strike. So always choose stocks you'd be comfortable holding long term. And so now that you know exactly what to look for, let's talk some numbers, like how much do you need in your account to actually get started with this strategy? Because here's what's great about selling options. You don't need a huge portfolio to start. You can begin with as little as $5,000 to $10,000. Although, the results do become truly life-changing once your account reaches around $100,000 or more. And let's walk through the math of this. With $5,000 to $10,000, you can comfortably sell puts on stocks priced anywhere between $20 to about $50 a share. And that's realistically going to earn you $200 to $300 per month, which is not life-changing yet, but it is a fantastic way to learn the ropes and steadily grow your account. Once you get to that $25,000 to $50,000 mark, you gain access to a much wider range of stocks, and your earning potential is getting upwards of $1,000 per month at that point in reliable income. And then once you hit $100,000 or more, that's when things get truly exciting. Because at that level, you're looking at, on the low end, $1,500 to upwards of $3,000 per month, which is enough to cover many people's basic living expenses. And here's the best part. As your account grows and you can reinvest your premium income, that's where the power of compounding kicks in. And this is exactly how some of my students have accelerated their path to financial freedom. So for example, Anthony has generated a remarkable 56.3% return in just 1 year. Another student, Janice, took her whole family on vacation to Europe with her options return. And then you've got Helen, who had never traded a single option 12 months ago and now is making $2,000 a month consistently from a modest portfolio. These aren't just outliers. These are the kind of results that become possible when you implement this strategy correctly, consistently, and with the right stocks. Now, let me be completely transparent. These results aren't guaranteed. And like any investing strategy, there is risk involved. But compared to traditional buy and hold investing, this approach gives you far more control over your returns and allows you to generate income in virtually any market environment. Because the reason this strategy is so powerful, if you're looking to retire earlier, is it transforms your portfolio from a slow growth vehicle into a consistent income generating machine. And instead of needing a massive account generating small dividends, you can reliably produce 15 to 20% annual income from a much smaller portfolio. And think about what that means. You could potentially live off a $500,000 portfolio instead of needing $1 million, 1.46 million, or even 2 million. And that's the difference between retiring comfortably at 45 versus waiting until you're 65. And here's where the strategy becomes truly powerful. Once you own the shares, you can turn around and you can sell covered call options against them to earn even more income. And this combined approach, selling puts then covered calls, is called the wheel strategy. And if you want to know what that's all about, this video on screen will walk you through how exactly that works, along with the earning potential of that strategy. So go check it out.